Now, to understand this, you have to read this question. Basically, what it means is if your qualifying expenditure day one is not the same as the cost of the asset, you have to subject the asset to exception rule. Let me just explain. This is carrying amount, this is tax base. Initial recognition is, it means day one. So day one, when you purchase the PPE here, PPE, the cost is, total cost is 95,000. But out of the 95,000, you have a qualifying portion and a non-qualifying portion. Because in this question, it says, under Australian tax laws, luxury car tax threshold caps the maximum depreciation deduction to 77565, and this is the maximum tax depreciation deduction, just like your capital allowances. So the qualifying expenditure for tax is 77565. When we have this situation, you will notice this asset in the accounting books cost you 95,000, but tax is only going to give you a tax deduction of 77565. We cannot take 95 and compare against 77565. So we have to split this asset into two categories. The qualifying asset portion, which you match this against the same number, qualifying portion, and this will be $95 minus 77565, which is 17435. Once you do that, you put a zero here, you don't provide for deferred tax. So when we read this, it says, discuss the deferred tax implication. So on initial recognition, day one, we book in the accounting entries. In the accounting books, you will debit 95,000, you will credit your cash or payable. The tax base of the motor vehicle representing its future deductible amounts is 77565. This is the maximum tax allowance you can get. Then the initial recognition of the car does not affect accounting profit or taxable profit, and the entity is not a business combination. This is not a business combination. Business combination is acquiring this asset via a subsidiary, but this is not the case. So the initial acquisition of the car does not affect accounting profit or taxable profit, and the entity is not a business combination. Therefore, deferred tax liability on the 17435 will not be recognized. So you do not recognize deferred tax here. This will not be a question where you have to do the calculation. This could be a question where they test you on theory. So if you are given a theory question where they say the cost of the asset is 95,000, but you can only get tax exemption up to 77565, you have to limit the asset cost to a qualifying and non-qualifying portion. Only the qualifying portion will give you the deferred tax effect. The non-qualifying portion do not recognize deferred tax. Unless this asset is acquired, or this asset is in a subsidiary that is acquired, and that is chapter 3. This will be single asset. And there are two recognition examples. Now, we do not also recognize goodwill. Goodwill, there is no deferred tax. So firstly, an entity is not to recognize DTL if it arises from initial recognition of goodwill. So when you have goodwill on the balance sheet, the tax base is 0, you also will exempt the calculation of deferred tax. So we have, let's say you have goodwill here. You will have carrying amount, you have tax base. Tax base is 0. Example, carrying amount is 10,000. This also you do not provide for deferred tax. You will have a temporary difference because goodwill tax base is always 0. So you will have a difference, but you are exempted from providing deferred tax here. If they were to ask you on this rule here, now this is, what is this? Goodwill. Right, so goodwill would not be recognized as the deferred tax liability. If the deferred tax, it would be identifiable. It would be an identifiable liability. Assume the revised goodwill will require recalculation. I will give you, in the standard, actually there are 3 exception rules. You notice here is, the first rule is here, where we do not recognize deferred tax. The first rule is an entity is not to recognize deferred tax liability if it arises from initial recognition of goodwill. Means these are the 3 situations that I'm going to give you that you do not recognize deferred tax asset. So the second situation is here. So this is the second situation where you do not recognize deferred tax asset. If the question asks for where are the 3 situations, the 3 situations that we do not recognize deferred tax asset, 1, 2, and the third one is here. This is referred to as recognition exemption for DTA and DTL, but they didn't write the first rule properly. Instead of writing in words, they put it here. They put the first rule here. Or this is one of the rules. And then we go on to, there are actually 3 rules, right? So they have listed this rule here. Because I don't want to copy, I just give you this. I cannot. This is one rule. And the second rule is here. So actually the 3 situations are, this is 1, this is 2, and this is the third one. These are the 3 situations that we do not recognize DTA or DTL, even though we have a temporary difference. So the first rule is an entity is not to recognize DTA or DTL if it arises from initial recognition of goodwill. To resolve all these, I'm just going to give you whatever is in the standard. I just copy this, and you just copy this wholesale into the answer if you are asked. Basically, what they are looking at is this MFRS 20. Tax is 25. Is it? 112, sorry, it's 112, 112. Paragraph. I give you the asset, the liability portion. Paragraph 15 is this paragraph here. Don't go and read this standard because it's going to be quite difficult for you. So what they are trying to say is, this is the section. A deferred tax liability shall be recognized for all taxable temporary difference except for this, perhaps, I think, the amendment, they didn't update it this year. Because this amendment was in 2023. See whether they combined it. Okay, yeah. So what I'm going to do is, I'm going to cut this. These are the 2 rules here. And I combine it with, because when they update the standard, they don't update it into the standard. Then we go into para 39. So this will complete the 3 rules. So what the rule says is, if they ask you, right, so you say a deferred, but the rule for asset and liability is written in separate paragraphs. So you just put here, a deferred tax liability or asset shall not be recognized for all taxable or deductible temporary difference. And these are the three rules. 1, 2, 3, which is the same as deferred tax liability is not to recognize deferred tax liability if it arises from initial recognition of goodwill. So you do not recognize deferred tax liability from the initial recognition of goodwill. But the second rule, it is easier to understand if it is written here like this. But your second rule is written in the flowchart format. So you do not recognize deferred tax asset or liability at the initial recognition of the asset or liability. So this paragraph is this paragraph. Then they go into it's not a business combination, and at the time of the transaction affects neither accounting profit nor taxable profit, and this. So you do not recognize DTA or DTL for Part B or Part B. You do not recognize DTL only for Part A because goodwill will give you a taxable temporary difference. And the last rule also, do not recognize a DTL. I think it's DTL last rule, is it? DTL. Or it can be a DTL or DTA. You are not required actually to understand why, but the why just now I explained to you is here. The cost and the qualifying expenditure must be the same. This has not been tested before because this is not an easy area. Even in practice, we find it difficult. So if they ask you, you just say there are 3 instances for which you do not recognize deferred tax. Initial recognition of goodwill, then you copy initial recognition of asset or liability in a business transaction, which is this. Lastly, you do not recognize DTA or DTL. Instead of this long amount, this long sentence, you can use this. So this is the way it's written in your study guide is do not recognize DTL for goodwill. Do not recognize DTL or DTA for an entity. Is not to recognize DTA or DTL when it arises from here. We do not recognize DTA or DTL at the initial recognition of an asset or liability that does not affect accounting or taxable profit. I don't know why they put this in here because this is very complex. Maximum marks, 2 marks only they can give you, theory question for this. But you cannot say you are willing to just leave the question and don't take the 2 marks. So this I did not cover it yesterday, and I just wanted to highlight prima facie tax. Make sure you just take accounting profit and all this, right? So this is also an area that hasn't been tested before. But there's no example on this. You notice there's no example given on this. Except they give you the template. So the prima facie tax is to explain why your tax charge is not 30% of the accounting profit. Where is the tax liability? current tax is this amount. Why is the current tax this amount and not this amount? It's because of all these adjusting items. So we've covered this chapter. We now move on to the next chapter. Impairment of non-financial assets. Now, impairment can be in two sections: non-financial asset as well as financial asset as well as goodwill. So you have impairment. This is non-financial assets. For financial assets, this is in chapter 2.6. This question will never be the same as 2.6. 2.6 will always be one separate question for impairment. But this question, this is IAS 36. You can plus chapter 3.2, impairment of goodwill. What your study guide has done is they have split this impairment of goodwill into two separate sections, 2.2 and 3.2. But exam, they're not going to test you only on 2.2. They may combine 2.2 and 3.2. But they cannot teach you everything together because impairment of goodwill comes from consolidation. I have always told the class, what did I tell you on this 2.2? You must always get how many marks on this? 100 marks. Because based on all the batches that I have done, you all always get very high marks with this section. So I don't see any exception for this batch. Somehow you all seem to do very well for this. So don't worry, this will be your good section. To calculate goodwill, when you say non-financial asset, it will be for PPE, property, plant and equipment, using cost or revaluation model. It can be for intangible assets, including goodwill. It can also be for investment property measured at measured at cost. Any asset measured at fair value, there's no impairment loss. Now, what do you understand by impairment loss? You purchase an asset. Now, this is not financial asset. So you purchase an asset, but the income that can be generated from the use of the asset is less than what is the carrying amount. That is impairment loss. If you have a machine, the carrying amount is $100. If you use it to produce goods, you only get back 80. That is the recoverable amount. In accounting, your asset cannot be carried at 100. It must be carried at 80. Because if you carry it at 100, you are overstating the asset value by 20. Asset is always subject to overstatement, which shouldn't be there. Liability is always understatement. So when you look at your AR paper or when you're doing auditing, the risk is always overstatement of asset and understatement of liabilities. So overstatement of asset is where we have to look at impairment. So step 1, indicators of impairment. Step 2, determine the recoverable amount. You will be asked to calculate. Right. Step 2 is calculation. Step 1 is a theoretical question, impairment indicators. So you need to identify the indicators. And the words here are impairment indicators. So it must be negative factors that bring the asset value down. A pandemic is an impairment indicator because in a pandemic situation, businesses are affected. When businesses are affected, your revenue goes down, your returns reduces. But does your depreciation change? No, because depreciation comes from the asset value. So if your returns from your business cannot cover your asset value, this is normally non-current asset. You write down the asset value. So indicators of impairment, there are two types of indicators, internal and external. Once there are indicators, you calculate the recoverable amount. So the calculation is in step 2. Recoverable amount is the higher of two figures, value in use and fair value less cost to sell. Value in use, you do not need to calculate, it will be given in the question. Fair value less cost to sell, fair value will be given. Cost to sell will be given, but you must select the correct cost to sell. Not everything can be deducted against the fair value. Next step, determine the CGU's carrying amount, where you have to allocate corporate assets. The step 2, step 3, step 4, all these are calculations, and those calculations will come from the study guide or the practice questions. So once you cover the practice questions thoroughly, you will be able to cover 2, 3, 4, 5, and 6. This section applies to impairment loss calculation. Impairment loss other than goodwill, once you provide, you can reverse. Goodwill impairment loss, you cannot reverse. So other than knowing how to calculate impairment loss, there will be another section to cover reversal of impairment loss. To calculate impairment loss, these are the steps you have to remember. Reversal of impairment loss, also steps to remember. So recap of accounting for the impairment of individual assets. So we have carrying amount minus recoverable amount, which is the higher of, then you get impairment loss. Another way to present this will be, your carrying amount is always here. So what we are calculating is the recoverable amount. A recoverable amount can be higher or lower than carrying amount. If RA is higher than CA, no impairment loss. If CA is higher than RA, this is your impairment loss. But to measure RA, it is the higher of fair value less cost of disposal or value in use. This will always be given for your exam. This comprises two figures, fair value and cost of disposal. So this is the area that you need to know. What are the items you can offset against the fair value? Fair value, there's only one price. You don't have to determine. So fair value will always be given as well. So the purpose of impairment loss is to determine the RA. So we are going to learn how to calculate the RA. So recognizing impairment loss. It can be for individual assets or it can be a group of assets. Individual asset is one asset. So when you calculate, you compare recoverable amount and carrying amount. Now, impairment loss, if there is immediately taken to profit or loss account. So you link this back to the next question here. Impairment loss. Where is it? Here. Impairment loss goes to profit or loss account. This is for asset using cost model. If it is an asset using revaluation model, go back to this principle. Because you have to check whether previously you have provided for impairment loss or not. This is first time. This is second time. This second time is where it links back to here. Does the revaluation surplus already exist? This model here is this model here. Subsequent. If first time impairment loss, always take it to profit or loss account. If first time impairment loss, profit or loss account, but subsequently, if you have a loss, you have to check whether previously you have a gain or previously you have a loss. Revaluation increment is previous increment. Now, you have first time, this is first time, you can have a revaluation gain. This is for asset on revaluation model. Let me just put the flowchart because there is just the number. So first time revaluation gain, you will have OCI. Subsequently, you can either have a gain or a loss. So the loss, you can have the loss first offset OCI first. Then if you have any subsequently, if you have any, so you offset, you have excess, then this goes to profit or loss account. If you have gain, this is OCI. Do you all see this? First, if you have a gain, subsequently you have a gain, you just increase the OCI balance, right? But if you have a gain first and you have a loss, you debit the loss to the extent of OCI. Any excess, profit or loss account. If you have first time loss, you will have already debited profit or loss account. And subsequently, you can either have a loss or a gain. If it is a loss, you just increase profit or loss. If it is a loss, then a gain. The first step is you have to make good the previous loss. Then any excess goes to OCI. So that is what is in this chart here. This one here. So these are all the possible situations. So to link this back to the impairment loss question, if any asset is on revaluation model, you look at the loss. Is it a first time loss or is it a subsequent loss? It doesn't mean for revaluation model always profit or loss account. As long as you have OCI, you debit against them.